Okay. Good afternoon, everybody. I just had a little bit of trouble getting my microphone sorted out. So if you can't hear me very well, just let me know. It's using microphone in my web camera. So if that's working, that's good. I've got the recording going. So we're starting with that. And so we might just get into our class. I'll do that by starting to share the screen. Okay, so hopefully you can see the screen there, and we'll get the PowerPoint started. Okay, so you should be seeing the first slide there. Okay, what we're going to be doing today is looking at really advanced issues, like really capital budgeting Mark II. And we're going to be basically carrying on the discussion that we were talking about last week. And so there are a couple of big topics, actually a few issues that we're going to be working through and really sort of taking those things a little bit further. Before I get into that, though, there are a couple of background things that I did want to talk about. Actually, not that one. I'll just leave the PowerPoint up. Okay. The assignment is coming up as due fairly soon. And by now, I would assume that everybody is at least well underway, if not pretty close to finishing it, or perhaps finishing. I know there's a handful of people that have submitted already. So well done for the people that have got the assignment completed and uploaded and have done battle with the SurveyMonkey data input as well. There have been some questions about how to put the data in to both the assignment file and also to the SurveyMonkey. I'm asking you to leave out the units and the commas. And what that means is that $362.33 goes in as 362.33, and a number like 3.55% goes in ideally as 0.0355, 3.55%, 0.355. It's decimal equivalent. In the past, I've noticed that people don't seem to be able to do that kind of conversion very easily. So I expect one or two people are going to just leave the percentage sign off and put in 3.55. I'm going to get the marking thing algorithm to be able to recognize either 0.0355 or 3.55 to be correct. However, I prefer if you put it in as a decimal because that's really what the number means. Okay, that's for getting the material in. The real problem though is if you type in the percentage sign or the dollar sign or the commas. The maths in these things sees those symbols as upsetting what it thinks is a number, and so that's a bit of a worry. Okay, but putting the material like the answers into the SurveyMonkey survey thing is just a very efficient way of getting it uploaded in our COVID environment. Okay. That's one background issue. The other one is that I want to remind folks that of the material, in fact, the object of our study here. A lot of people are working very hard. Some people have got families to look after. There have been times during this corona craziness where people have had children at home unexpectedly and trying to study as well. And so that's produced a lot of difficulties. And the easy thing to fall off the map, especially when you're doing unexpected distance study, correspondence school, is that there's a tendency to leave your studies to the very end or to the sort of little butt ends of your resources in amongst sort of work commitments and keeping a household together and all the other stuff. There's a problem with that in that you really have to put in the time for study. And a number of the questions that have been raised or correspondence that I've had, while people come along with, you know, this question or that question, kind of lurking behind it, it's sort of fairly apparent that people want to be able to get everything done without actually doing anything, or at least not doing enough. It's very hard to study without spending time. And I know we're getting more and more time poor as we get further into the complexities of our culture. But that's a simple reality. It's a psychological fact. Humans can't just pop a pill and learn finance or mathematics or basket weaving or anything. Learning is something that takes time. The university adopts the credit point rating system to quantify the amount of study that's involved in each one of its units. And so this is a 6 credit point unit, which means that if this unit was run for a year rather than a term, it would require you to spend 6 hours a week for every week of term in study, not necessarily in class, but certainly in study. That's what 6 credit points means. It's a standard which I think was started in the United States, and it has this very simple correlation. We now aren't studying over the full year. Maybe we could be doing a class a week for 12 months doing business finance. That's probably a nicer way to study because we'll be able to introduce these things a bit more gently. You have more time to go off and think about them in between class. When we sort of fold it into 12 weeks, that does compress it somewhat. And I've had to teach some units where all of the classwork was compressed into 3 or 4 full days. Well, more like 5 and 6 full days. That's very, very intense. I don't think the learning quite works as much, and it actually makes it harder for students to learn. So if you're feeling a bit frustrated that things aren't making sense, there's really sort of 2 things that are kind of likely to be going on. And they are what I would think of as almost psychological realities. One is that you can ask yourself the question, am I spending enough time on this? Or am I trying to cram it all in a very short period of time? If you try and do that, inevitably it'll be very hard and you won't get very much value out of it. Time, if we have the unit spread over only 1 term rather than the whole year, it means that you should be spending on average 12 hours at your books or at something, learning business finance every week. And 2 hours of that is here in class, but the other 10 hours you have to make up in your own time. I'm just going to take off the share for a moment. Okay, now I put it back on again. Just had to make sure that the recording was working. Okay, so spending the time, really, really important. For folks who have found that life is sort of too complicated for them and they haven't had a chance to maybe get onto the Moodle site yet or read the textbook or whatever, and suddenly they got the assignment instead of trying to do it all at once. For some people, especially if you're really smart, you might be able to pull that off acceptably. But for most of us, it's a good way to really compromise the likelihood of success in the subject. Maybe I shouldn't be saying that in week 7 because we should have been saying it in weeks 2 and 3 and so on, and not encouraging or not, not making it too easy for you to get behind. But there we are. Put in the hours and keep up to date with the work. There's no point in trying to work it all out the night before an assignment is due or the night before the exam and so on. A lot of people do that. It's a bit of a classic kind of university student kind of bit of behavior, but it's also a classic way to have trouble and, dare we say it, to not pass. And I don't really want that for you. My goal as a lecturer, as your professor, is to get you guys to learn this stuff so thoroughly and enjoy it, hopefully, to the point where we could get you to come back next year to teach it, because that's really all we're doing. This is not like school, where there's such a gap between the content that you're learning and the student's ability. If you're in high school or what have you, and you're doing maths, you might be doing really hard and tricky mathematics, but you kind of know that mathematics is a long way behind serious mathematicians. When you get to university, that gap actually closes. We're teaching you finance of the sort that the best people involved in financial management are using. That's about as complicated as it gets, and it's probably one of the reasons some of you have had trouble. But it does mean that once you learn this, if you read the textbook cover to cover and it makes sense to you, then there's really no more to be learned. You know about as much about finance as anyone in industry does. Okay, and that's largely because we're preparing you to go out into industry. And I'd like you to be able to go into industry and succeed. And that's very much how we're running the unit for you. Okay, a related issue is the importance of reading. Okay, we've sort of said you've got sort of 10 hours of learning to do, 10 hours of study to do, whether it's doing the assignments or doing background reading or maybe pondering over what we've covered in class or preparing for the exam, whatever it is, it needs to be 10 honest hours of work. One of the important things there is to go through the textbook. And it's really handy if you've got the textbook. I can't insist that you have a textbook, but I can tell you that if you don't have one, you're going to find it mighty difficult. Now, those of you who have the text and are actually reading it diligently and following all of the resources and all of the directions I'm giving you will have noticed that by and large, the PowerPoints are a summary of the textbook and are kind of like bare bones. If you know the PowerPoints backwards and forwards, up and down, you can get through and pass the subject, might even be able to get a credit without reading the textbook. Yep, that's true. And that's largely why there are so many slides. We don't have a snowball's hope in hell of getting through 70 or 80 slides in 2 hours. It's a summary. But it's not the only part of the work. And if you run the more risky route of trying to get through the unit without actually buying the textbook, okay, and if you're up to year 7 and or week 7 and you haven't got it, yeah, okay, you might be able to pass the exam. I hope you do, but will you get a credit? Yeah, remote chance. You certainly won't be getting anything higher. And so if you really want to only just scrape through and increase your risks of failure in the course, a really good way is to not do the background reading, okay? I think it's unfortunate because people think that they can get away without putting the time in, without reading the textbook, and then complain that somehow the lecturer hasn't done a very good job. And I rather hope you kind of avoid falling into that trap, because at some point you have to take responsibility for yourself. So there you go. Halfway through, I'm giving you an incentive or some hints as to how to be really successful for the other half of the course, because we're now just halfway. And do take it seriously. One thing which does strike me as odd is that if I was to go down to the shops and go to buy something really important, maybe a new car or something or whatever, I would want to get good value for my money. For every dollar I put down, I'd want to get the best out of what I'm buying as possible. I don't go down to Woolies to buy a bag of potatoes with the intention of bringing home a bag of rotten potatoes. The bag of rotten potatoes somehow got forgotten in the Woolies sort of veggie section, and the good set of potatoes, they're going to cost me the same amount of money. Just the way as your education is going to cost you the same, whether you spend your time down the bar and don't worry about doing your work, or whether you put the hours in and the interest and do a really good job. It's just like bringing the rotten pack of potatoes home. You're going to spend the same amount of money on your education, but you're going to have something which is really no good for you at all. That's something that I think you need to sort of take seriously. I don't want anyone to come away with a HECS and a fail, but one way or another, the cost of the course is there set in stone now. So make sure you get the best value of the materials, the resources, and so on that you have available. Okay, I think that's the background stuff. Now we're going to get into the question of capital budgeting, advanced capital budgeting. We're going to be basically scooting through chapters 9 and 10 today, and we're going to be looking at more background issues, probably more on the theoretical side than in the practical number crunching side. But there are a couple of things to do with number crunching that I'd like to run past you just before we get started. And to do that, I'm going to show you a couple of diagrams. The first one is this fella, which is an example. Admittedly, it's done on Excel, and you're probably starting to pick up that I'm a bit of a fan of Excel. And this diagram is, I'm putting it up just to show you what I mean. Hang on, let me put this here. What I mean when I recommend to people that they do a cash flow diagram. A number of you who I have corresponded with by phone, by email, or on the forums will know that often when people ask me very good questions about working these things out, I'll often say, well, the best way to do such and such is to start off by doing a cash flow diagram. Okay, this just happens to be one which, yeah, okay, I did it in Excel, but you can just do it on the back of an envelope with a pencil or maybe a thumbnail dipped in tar. It doesn't really matter what you do it with. It doesn't have to be to scale. It doesn't have to do anything else, but simply give your mind the opportunity to see laid out the timing of the cash flows. Right? And so when you're doing the assignment, if you haven't done it yet, especially some of the ones further on, some of the more complicated questions, where you've got to work out what's happening with these cash flows, a really, really handy thing to do is to set out something like this. What is it? This part of the cash flow diagram is nothing more than a timeline. Starts out time 0, beginning of the game. You are here at the end of time 0. We're assuming that the cash flows are going to happen at the end of each time period. And cash flowing into my pocket, I put as a good thing, so it's an up arrow. Cash flows flowing out of my pocket, like the cost, is a bad thing, so it's a down arrow. That's all it is. Now, you don't have to do it in Excel. Actually, it's a bit tedious doing them in Excel. Just do it with an old piece of paper and a pencil, and you'll be right. Why do you do it? Why do you waste time writing out one of these diagrams? Well, the reason is it's a really good way of visualizing how big the cash flows are, which direction they're going, and when they're happening. And that really helps you bring them back down to the present. For instance, in question 5.2, I think in the assignment, we say that we've got an investment. Hang on, I'll just move this a little bit. I'm going to move it over to here. We've got an investment that I can't remember exactly what it does, but basically it sort of provides a dividend, which has a regular pattern, actually a regular pattern of growth going off into the future. And you've got to work out the value of that security. Okay, it's 5.2. When we get to, I think it's 5.3, I better check that. There's another one that has a bit more complicated, which has got the early supernormal growth pattern in it. Okay, and what we've got, and I'll just crop this diagram a bit. We say the first dividend's only going to be about 20% of the eventual regular dividend, and the second one is 50%. The third one is 80%. The fourth one is where it starts to settle into its long-term pattern. The long-term pattern now, as I say, in that particular example, the long-term pattern is growing. So this might go 100, 110, 119, whatever. But these are regular, and these ones are growing. Now, by drawing the diagram like this, I've already helped myself to conceptualize when the cash flows are happening, what the patterns are doing, what the relative magnitudes are. So I've got all of this kind of information, this complexity, all just drawn on this very simple diagram. Okay, and all of a sudden it becomes really easy. I might have, I don't know, a dividend of $5 that's going to grow at 3% forever. Okay, so that's the nice, well-organized part of here. And then in the question, it'll tell you that you're going to have 20% of $5, 50% of $5, 80% of $5, whatever the numbers are. And so you can conceptualize that. How do I work out all of this? Well, I can work out this part of the investment from those cash flows, and I can work them out, worked back to this point here, where my cursor is. Then I have to present value that back to the present. But I also have to present value this fellow back to the present. So that's 20% of my $5 discounted by a year. This one, 50% of my $5 discounted by 2 years. This one, 80 or 85, whatever the number is, discounted by 3 years. And then, of course, this fellow is also going to give me a present value at this point in time. I'm going to discount that by the 3 years as well. So we can work out our things like that. Okay, I won't go any further down there, but I just recommend to you, use that type of a diagram written by hand to deal with tricky cash flow arrangements. I haven't done it the last couple of years because I haven't been doing very much consulting lately, but when I was seriously in consulting, occasionally I'd have problems where I'd still come back and draw these things because of some, odd development project or something that needed real sort of, careful planning for where the cash flows are going and when. Okay, we can put that away, but just remember, I don't need that. I want to move to this one. Here's another background idea. Again, this is not dealing with the our PowerPoints yet, but it's an important concept for you. You'll find this in the textbook, by the way. If you flick through, I just can't remember the page I got it from, but you should be able to find it in the textbook without too much trouble. I'm just putting it in front of you because the topic that we're looking at today relies on a theoretical approach to the accounting situation that often people don't consider. When I first started studying finance, I'd done a lot of accounting before. I'd done economics. I'd sort of been managing businesses in practice. But I'd never really thought of the profit and loss statement as anything but the end of the accounting process. And if you guys have done accounting, you would have already seen that. You do your ledgers and your journals and your MYOB or whatever it is that you're using for your system. And right at the end, you press a button or do a whole lot of sums or whatever, and you end up with two reports coming out, your balance sheet and your profit and loss statement. And so that's it. You do that, and that's it, the end of the game. Right? Finance actually starts with the profit and loss statement and to a certain extent the balance sheet. And it uses that as the starting point. Okay, so the accountant comes along, does all this hard work, gets to a balance sheet and a profit and loss statement, goes home. The finance person comes in, picks up those two reports, and that's their starting point, that's their foundation, that's their raw materials. Right? And so we have to look at how the finance mind, the finance manager, whatever you want to call that role, that sensitivity, as using this thing as the starting block, right? And it's something that you manage. You say, what do I want this part or that part of my profit and loss statement to look like in 12 months' time? Here is what it is right now from the last year. What am I going to do with it in the future? Am I going to change the leverage structure of the company? Am I going to change my stocking policy, my use of current assets, my approach to debtors, all sorts of things? It all comes down to managing this thing. Am I going to own my capital assets or am I going to lease them? Again, you're managing the profit and loss statement. So we look at the profit and loss statement not so much as the end point, but as the starting point. And for that, you need to conceptualize how it all fits together. Okay, and so this is a good time just to review that. The profit and loss statement has a number of layers, and we're going to be particularly interested in the middle layers, oddly enough. Let's just go through how it works. Profit and loss statement has your revenue, maybe sales if you're doing a shop or maybe producing some service or what have you, revenue. Out of that comes two types of expenses. They're generally both under the umbrella of operating expenses, OPEX, but the two expenses are those which are fixed. You know, you're going to pay the rent on the shop you're operating regardless of whether you're selling stuff or not. That's fixed. You're going to be connected to the internet. You're going to be having a telephone. You're going to be paying for electricity. You're going to be paying for water, for wages, for who knows what else. A whole lot of things are actually absolutely fixed. So they're fixed operating expenses. But as well as that, you also have variable operating expenses. And the variable operating expenses are things like replacing the stock on your shelves or buying more raw materials to replace the ones that you've used up in producing the widgets that you're making for sale. And so you've got some expenses that actually vary in proportion to your revenue. So they're variable expenses. Both of them roll together to give you your operating expenses. We're going to be looking at that. We're going to be actually dissecting that. We're going to be saying a few words about that today, hopefully. By the time you take those operating expenses away from revenue, you've really got the operational, the pre-tax operating profit. It's actually more than pre-tax, it's also before interest. Why is interest and tax separated away from, you know, as a separate class here? The reason is this. Above this line, everything has to do with the operation of your business. The operation of the business might be selling something, or it might be producing for sale something. So if you're a brickworks or what have you, you're making bricks to sell them. If you're an accountant, you're spending time, you're using human resources to make something, you know, nice tidy sets of books for your customers in order to sell it to your customers. So you're all the time making and selling above the line. Once you get here though, from here on down, it's all finance. It's taking this quantity, this operating profit, EBITDA, and then you're making decisions. And you get to make these decisions, certainly if you're in the finance role. You make decisions about the amount of debt that the company is relying on. That has a huge effect because debt used wisely can multiply the dividends to the shareholder. To a certain extent, you get some control over taxation. And that's a fairly complex area in itself, but your goal is to minimize legally the taxation that you have to pay, or at least manage it so that your taxation is working for you. I mean, you have to pay tax, but you may as well do it in such a way that is least troublesome. And so we talk about tax minimization, which is the legal management of tax to get the right result, which is always legal, versus tax avoidance. Similar words, tax minimization, tax avoidance. They both sound like you're trying hard to pay less tax, and that's exactly true. However, tax avoidance is where you hide away from your legal obligations for taxation. You run two sets of books in your shop, or you deal with cash rather than you know, through the normal books of accounts, things like that. Illegal things, bad things. Okay, but within tax minimization, there's a lot of scope for making sure that you manage things in such a way that you don't pay more tax than you legally have to, and you may even make decisions in running your business which are not so much designed primarily for business sense, like in terms of helping you to sell more widgets, but it's actually to sell your widgets in such a way that you don't have to pay as much tax as you may have otherwise. Okay. So at this point, we don't have interest and tax taken out. This expression here, EBITDA, in earlier and simpler times, we used to simply talk about EBIT, EBIT, and that's earnings before interest and taxes, earnings before finance, basically. These days, we make the acronym even more ugly by adding these 2 extra letters, and even those 2 extra letters don't fully capture what this level of quantity is, right? What you're actually doing is say it's earnings like profit, then before, and now we start to take off a list of things which the owners of the company can manage. They can decide how much debt they're going to be carrying. They can decide to a certain extent how to structure their taxation obligations. The D and the A stand for depreciation and amortization, which are both heavily related to managing your tax. Okay, but the idea here is that this number here, which is very, very important, is the number that comes from the operations of the organization before you start considering things that the owner can manage to maximize a profit without necessarily changing the revenue and operating expenses. Okay, so down here is all stuff where you manage simply to increase the profit-making potential of a constant amount of business, actual work. Right? It's one of the most peculiar things I found as I was coming from, shall we say, the more operations area. At one stage, I ran a survey business, like doing land surveying and property development. And so I was very interested in that. And at that stage, I was also studying commerce, and I was doing finance and all that sort of carry on. And I was starting to discover the power of this thing, because this really can magnify the profitability of this. Okay, very, very important. So we're mostly going to be looking at what happens from EBITDA, EBITDA, down to your free cash flow. Okay, so I just put that up because I want you guys to just think about it, because if you think, okay, then this is really what we're doing here. We're looking at these things critically, each one of these. How do we maximize the free cash flows, the dividends, if you like, without actually changing the revenue, without actually changing the physical thing that you're doing to the community. Okay, that's a little bit of background. We'll come back to that. This diagram, by the way, is on the Moodle site, and it's below the recording for the class. And this week I've loaded up the recording for yesterday's class because it seemed to cover everything that we needed. And I'm not sure whether I'll put up today's as well. We might put up both of them. But anyway, this diagram is there, and also the Excel diagram showing the cash flow diagram is also on Moodle. So get those out if you like. Okay, don't need that. Got rid of that. Okay, so that's all preliminary. Let's get into what we're going to be going through now. Now, similar to most weeks, I'll be getting you to read a lot of these slides, so I'll just be skipping them through, sort of maybe talking to some of the theory ones, but mainly saying just read this, right? Rather than me just kind of prattling on, because if I just sit there and read the importance of capital budgeting, you're going to find it deadly boring. So am I. You won't learn much, and we'll waste an awful lot of time. Well, there's a whole lot of stuff we do have to read, and so I would just put it to you, don't rely totally on what you hear in this 2 hours we've got together, but read through these things yourself, think about them, make sure that you really accept them, like they make sense to you. Okay, and if they don't make sense to you, read a bit more in the textbook, maybe reflect on it, talk to somebody, whatever. Okay. We've already talked about that, I think, more or less last week. Some of the ideas, by the way, last week, I was kind of actually talking about ideas that we're going to be covering here as well. They weren't quite on the script for last week, but I find it hard to keep them separate. Okay, I think we talked about the different types of project circumstance last week. So here we're talking about the incremental after-tax free cash flows. What we're talking about there is that if we're running a big business and we're going to add some new business line to it, some new project, then what we're saying is, like BHP might sort of decide to start a new mine somewhere. So BHP's got mines all over the place, and they've got a whole lot of other people doing all sorts of important things. And then they're thinking, oh, I think we might open, a new mine at Tanglang-Maloo. And we're going to, and why are they going to do that? They're going to do that because they believe it's going to increase the shareholders' wealth. It's going to add to their bottom line, if you want to use the jargon. It's going to increase the value of the company. How do we analyse it? Well, we don't analyse all of BHP in order to work out the performance of Tanglang-Maloo mine. What we're going to do is we're simply going to look at those little extras, the extra revenue, the extra expenses, the extra depreciation, amortization, tax obligations, interest payments, and so on, due specifically to the difference that's made as a result of having that extra mine. Some cases there might be, well, most cases it'll be extra numbers going into your analysis. In some cases, it might actually also help some of the others, as a result of opening the mine at Tanglang-Maloo. There might be some idle resources getting around that actually aren't working very hard, some mining equipment or who knows what, temporary offices or whatever, and they might be moved in. And so you actually might be saving a cost somewhere in your business in order to apply them here. And so you're looking at these changes. Pretty much read through that. It should explain it. Now down here as we go through, you'll notice I was talking about this before we started. Okay, and really this is one of the examples in this set of slides where we are getting you to think about managing your profit and loss statement. So read through those. Yeah, okay, I think you'll find that pretty straightforward. What we're basically working for is to get down to the point where we're looking at, when we're talking about free cash flows, we're actually meaning the cash that comes into my pocket. After everything else is done, paid the tax, paid the bank, paid this, that, and the other, what cash is actually going out of my pocket or into my pocket as a result of this thing that I'm analysing? That's your free cash flow. Keep reading. It's an important concept. Well, hang on, I didn't want to go away from it. That we're all the time talking about cash flows in finance, and it does get a little bit repetitive, but I can't impress you enough. We're not interested in profits. And the reason is that accountants are extremely good at considering every little thing that might contribute to your profit or detract from it in this particular period, including things that haven't happened yet, or maybe things left over from the last period, what have you. And in accounting, when you're doing accounting, you would have come across two classes of, well, actually three classes of creature: prepayments, accruals, and intangibles. Now, accountants go to an awful lot of trouble to make sure that they quantify those and put them in the right box and allocate them in the right time period. But in fact, they don't involve cash. A prepayment means that the cash is actually gone in the wrong time period. It's been paid beforehand. An accrual is almost the same. An accrual is where nothing has actually happened. However, something is likely to happen in terms of someone writing a check in the future. So you'll have accrued obligations, you'll have accrued revenues that haven't actually happened. Now, the accountant says, yes, that belongs here. You might have staff that haven't taken their holidays. So you've got accrued wages. At some point in the future, you're going to have to pay those people even though they're not working, or something similar to that. And so these accruals, again, they're not cash flow, but they do affect your profits. And the last one is intangibles. Things like goodwill, also things like depreciation. You don't actually see, you buy your computer, I don't know, $10,000 worth of computer. After 12 months, it might only be worth $8,000. You don't actually write a check for that $2,000 to just out of the business, but it happens as a result of the fact of this intangible thing called depreciation. Okay, I'll let you read through those. Got an example, that's fantastic. And we've got some examples. I'd like you to read through those in your own time. Okay, we're going to be looking at calculations. Now here we've got 5 rules that are worth keeping in mind, maybe writing out in the back of your hand or putting up on the wall in front of your desk or something. that give you an idea of how to identify cash flows and what to leave out when you're putting in cash flows. These are pretty handy. No accruals, no prepayments, no intangibles. So you include cash and only cash in your calculations. Rule 2, include the impact of the project on the cash flows from other product lines. As I say, if you're able to bring in some underutilized asset or what have you for some particular project, you're actually trimming the dead wood off some other projects, making it more efficient, and you're actually getting a benefit in your situation. And so you can have these interactions between different parts of your company. That's rule 2. Rule 3, including all opportunity costs. Last week I was talking about what happens if you had a vacant lot, whatever, and you get to either turn it into a hotel or a office block. Okay, the opportunity cost is no office block if you do the hotel. Rule 4, forget sunk costs. Sunk costs are those things that we've paid for in the past. The costs are made, and they're history. They're gone. Okay, you're never going back. So you don't worry about them in your analysis. You're only looking from the present forward. I remember having a lot of trouble with this when I was looking at sort of the accounting management and engineering projects. I remember being given the example of an engineer who's halfway through building a bridge, and something happens, and it becomes impractical to build the bridge there. And they say, okay, then the bridge is going to cost me $10 million to build. I've spent $4 million, but because of some discovery, let's imagine they discover that there's quicksand or something sort of in a spot they never expected. Instead of the bridge costing, what we say, let's say you've $10 million, but say you've spent half of it, you've spent $5 million. And because of this unexpected kind of future event, your best intelligence now says actually the bridge is going to cost me $20 million all up, which means I've still got 15 to spend. And you look at that and you think, oh, that's a bit nasty, but I've already spent the $5 million. I better get value out of this. No point in having a bridge kind of only half built across the river. I really like to finish my bridge, please. Well, rule 4 says, forget it. If it turns out that as a result of that patch of quicksand or whatever it is, it's going to make the bridge cost $20 million rather than $10 million, in other words, you've still got 15 in front of you, it might be a lot cheaper to build a new bridge somewhere else. It might cost you $12 million, right? So you build a complete new bridge for 12 mil, costs more than the old one, started from scratch, and you leave this half-finished bridge just kind of sitting out, sort of spanning across the water into nothing. You feel like a goose, but you've saved $3 million, right? And the fact that you've spent 5, forget it. That's gone, right? And if the benefit in the future is not going to be the best benefit from what you do from today, day one, up into the future, then you simply forget it. Any of you who either live in New South Wales or have travelled through Sydney, especially between Sydney and Newcastle, when you drive along the freeway that leads north out of Sydney across the Hawkesbury River, you see an interesting example of this. Okay, and those of you who may be living around the Sydney area, there's probably a few of our students that are in the Sydney area. Someday when you're hopping in a car going on a picnic up at, I don't know, Gosford or something, look out to the east as you're driving up the freeway, south of the Hawkesbury, and you'll see evidence of all these massive, massive earthworks. They've basically cut out large chunks of hillsides, right? And what's there? Just scrub, regrowth. What's happened? It turned out that when they first designed that motorway, they were starting to build it, and in fact they did get as far as basically carving these huge gaps in what used to be a hill. Now it's kind of looking very broken. It looks like the motorway should be there, it doesn't go anywhere, and it never will. And the reason was they changed their design, discovered a better design, and so it would have been literally millions of dollars that they'd spent there just carving out all the sandstone, and it's just there. Yeah, they've never bothered to build anything with it, forgetting the sunk costs. That's absolutely fascinating. But that's probably one of the best examples I've come across of where this has really happened big time. Rule 5, include only after-tax cash flows in the cash flow calculation. The reason is that ultimately it's only the cash that goes into your pocket, which is after tax, right? That one should be obvious. Okay, it's handy. I'll get you to read through these. These are examples and useful examples to read in your own time. They're nice. Now we're going to look at some practical factors. I think most of these also should be fairly obvious to you. And while I could read them out to you, you can probably read them just about as fast yourself, but also give you a little bit of time to think about them. We're talking about nominal versus real cash flows. When we're talking about real dollars, what we're talking about is adjusting for inflation. There's actually a couple of ways of doing this, but in our world, inflation is a perennial problem. You guys, most of you probably just think of inflation as just something which is always there. Oddly enough, inflation is really only a phenomenon which has become an issue over the last half century or so. When you look at inflation performance, say the other side of about 1960, one of the curious things is that there's hardly any, or there used to be hardly any. There was a bit of inflation after the First World War, a bit of inflation after the Second World War. There was a really peculiar lump of inflation for about 20 years between about 1970 and 1990, which has got some really strange kind of characteristics to it. But as a result of that period, we're now very conscious about dealing in real and versus nominal cash flows, because the real dollars are adjusted for purchasing power. That's kind of important. So hopefully that'll give you an idea of what that slide is on about. That's worth reading. Right. An important issue here, and it really comes sort of illustrated in that cash flow diagram that I showed you, is that the terminal year free cash flow is not typical. And the reason for that is that it has the end event. Now, if I'm BHP considering a new mine, I know that when the mine is finished, when that project is finished, it means the mine is not going to be useful anymore. And in the case of mining, I'm probably going to have a lot of environmental remediation to do. Remediation is a fancy word for cleaning up after you. And that can be an extremely expensive business. If my project is running some machine or some production capacity, then my final cash flow might be simply calling up some scrap metal dealer to come along and take out the old machines because they're no value anymore. And so we often talk about the salvage value as the final cash flow. If we're doing something where the capital assets involved are actually appreciating, and the best example of this is real estate, then the final cash flow isn't just scrap value, the way it might be for an old machine being carted away. It's actually a capital gain. And so whatever it is, whether it's an old machine being carted away to the rubbish dump or the metal recycler, or whether it's a real estate being sold for a lot more than you bought it for, one way or another, the final cash flow, the terminal year free cash flow, is a very important event. And it adds to the operating income. Imagine if you owned an investment property, for instance, and you decide to sell it in 10 years' time, you'll have the rent this coming year, the rent the year after, the rent after that, and so on, up to the final year. And at the end of the final year, you get your rent check. That's good. That's your operations income. But you also sell the property, and hopefully you make a nice capital gain on it. And so that end cash flow, that terminal year cash flow, is actually really huge. Very, very important. Okay, so read through that and think about it. That should be fairly obvious. Just read through. Okay. 2 or 3 weeks ago, when we were talking about risk, we were talking about estimating probabilities, and we went through the mechanics, the mathematics of working out weighted means. And this slide basically is simply an application of that for a set of cash flows. I mean, we were looking at something a lot simpler, but here it's the same thing, just a weighted mean. So it means that every element in that you're going to be taking a mean from is then just weighted by the probabilities. You guys have done this previously, so I don't want to spend too much time with it, but I don't want to send you off sort of into something that you don't really understand. It's an awful lot simpler than it looks. It just happens that the maths looks a bit complicated. What are we doing here? We're saying that in this project, the project is going to be running for, it's going to cost you today, and it's going to be running for 3 years. But I have different probabilities depending on how the world treats us. Okay, so it might go really well, might go average, might go badly. I've attributed probabilities to those. I've also attributed the various cash flows going to be involved. I'm simply doing a weighted mean for each one of those. I'm a weighted mean for the 3 probabilities for year 0 for the cost. Okay, that's easy because it's the same. But then for year 1, I have to do a weighted mean to work out what my first year cash flow is likely to be. Same with the second, same with the third. And then you simply take those numbers, minus 100, 48.75, 53, and 35, and simply just take the present value of those. So work through those yourself. Make sure that you understand it. Don't just let me waffle on and then forget it. It's nothing new, is really what I'm going to say. Worked example, worked example, worked example. Okay. This is a topic area which is a little bit tricky, and it bears on something that we were talking about last week. Remember last week, was it last week or previous week, we were looking at different forms of capital budgeting evaluation. We're looking at accounting rate of return and payback periods and internal rate of returns and lots of stuff. And we came down to the conclusion that NPV, rule of roost, was really a terrific form of capital budgeting tool. And that's where we left you. Well, the reality is, and here I have to sort of make a bit of a confession, it's not really that good, okay? Turns out there are some things you've got to consider with net present value that do make it a little bit more involved taking conclusions from it to simply. And that is because you can, the net present value, because of the units that it works in dollar units, present value dollar units. It naturally doesn't take account of 2 really important issues. One is the length of ownership, or the potential difference in lengths of ownership between different projects. And the other one is the different magnitude, the different scale of the competing projects. Let's imagine with my car park, I was thinking about putting in a hotel or an office block. Maybe a shopping centre, an office block might be a better example. Okay, the shopping centre of its nature is relatively low-rise building, so it's probably going to be less bricks and mortar, but I'm going to be able to earn more rent for every square metre that I develop. Okay, so it might cost me less to build it, whereas the office tower is going to cost me more because there's actually more square metres involved of built space. And it might take me longer to build, and it might cost me a lot more. But on the other hand, it might earn me a different type of rent revenue. So I've got 2 different kind of projects. I've got one block of land, but the timing and the magnitude of the 2 sets of cash flows are really quite different. Net present value is not good at being able to deal with those. And we'll just look at how to deal with those 2 different inequalities, we'll look at them separately. Okay. First one I'm going to look at is projects with different lives. For instance, if I've got a project that I've worked out is going to earn me a net present value of $1 million. You think, oh, that's nice. And then I have another project which I could do, mutually exclusive projects. So if I do one, I don't do the other. And it gives me a net present value of $2 million. Last week, we left you with a very simple conclusion. Well, two simple conclusions. One is that you always choose the project with the highest net present value. And the other conclusion, the other principle to work is you never buy yourself into a project which has a negative net present value. Okay? We don't have to worry about the negative net present value. We assume you know that. But here we've got a situation where I've just told you NPV of 1 mil, NPV of 2 mil. What are you going to choose? Now, from last week, you would say, oh, go for the 2 mil, thanks. Right? But then if I told you that it was going to take you 6 months to get your first project up and running and completed, 6 months. Okay. But it was going to take you 5 years for the $2 million project to return that benefit, that $2 million. Right. All of a sudden, you sort of think, oh, I don't know about that. Am I going to wait that long? Right? And that's a fair question, because the project's got different lives. I have to wait for a lot longer to get the extra $1 million. Okay, 6 months to get the 1 mil. What we say, 5 years to get the 2 mil. Well, obviously, I'm tied up for a lot longer, and something like that's not very attractive. Now, that's a pretty easy one to observe, like to recognise what's going on there. Sometimes you may not have quite that clear, crisp, almost absurd difference in lifespan of the two different projects. You might have one that's running for 5, the other one's running for 7, and it's sort of harder to work that out. How do you work it out? Simply, net present value itself doesn't give you the answer. You have to do something else. Read through this. What you can do is convert the projects into equivalent, if you like, perpetual projects. And you can work out a net present value to infinity for each of the projects. That's one approach, and I'll let you run through the maths there. Another approach is what's called the lowest common multiple approach, where, going back to our example, 6 months to get 1 mil and 5 years to get 2 mil. Well, if you think about it, if it's going to take you 5 years to go and get the extra $1 million, only 6 months to get an NPV of 1 mil. What's to stop you in 6 months, when the first project finishes, you get your 1 mil, from then doing that project again, getting another mil, and doing it again and again and again and again. And in fact, in 5 years, you can do a half-year project 10 times. And as long as, the business wasn't, the police weren't chasing you or something as a result of some dastardly thing that the business was involved with, it's like you'd be able to just keep on running the business. So you would have run it 10 times. And so in that 5 years, you would have got 10 mil. Okay, obviously, it makes that more attractive than the 2 mil one, even though the NPV itself is very high. So lowest common multiple is a way of doing that. When I mentioned like 5 versus 7 for the different years, for different lives, you could conceivably consider the lowest common multiple. The lowest common multiple of 5 and 7 is 35. So you think, okay, then what I'm going to do is I'm going to say, okay, I've got a 5-year project and a 7-year project. I'm going to run the 5-year project 7 times. I'm going to run the 7-year project 5 times. And so in 35 years, how much NPV do I get from the multiple running of the 5-year project compared to the multiple running of the 7-year project? That sounds probably harder to describe than it is to calculate, but it does equate them to a certain extent. There's a third approach. I think we've got mathematics here, so I'll just let you read through the maths. Yeah, this is the perpetuity one. There's another approach. There's a couple of them. I'll let you read that one. The annual equivalent cost approach. I'm not going to use that in practice, so I'll just let you read it. Awareness, da-da-da. The last one I'll just do is actually not in the slides, oddly enough, is a thing called the annual equivalent NPV. The annual equivalent NPV is simply dividing the NPV by the number of years it takes to realize it. And that's a nice way of producing an index that is able to deal with projects of different lives. So in the example I was giving you of the project which returns $1 million of NPV after 6 months, what that means is its equivalent, its annual equivalent would be $1 million, because if you divide 1 million by a half, same as multiplying it by 2, you end up with 2 mil. So your annual equivalent NPV for that first project would be 2 mil. If you look at the 2 mil NPV project that takes 5 years, the annual equivalent NPV for that will be 2 million divided by 5, which is what, 40%, 0.4. Right. Again, you end up with these two numbers. The first one has an annual equivalent NPV of 2 mil, and the second one has an annual equivalent NPV of 400,000. Now, by the time you then sort of say, okay, then I'll compare on the basis of annual equivalent NPVs, the difference in life has been taken care of. A similar thing can be done for differences in magnitude. Now, actually, before we get on to that, I'll just finish this discussion. When we're looking, I said there was a difference in life for projects, and we've talked about that with annual equivalent NPV and the lowest common multiple approach. If we have a difference in magnitude and scale, we use a thing called the Profitability Index. And there you say, if I've got the 1 mil project and I have to tie up $1 million worth of assets in order to do that, then I can work out the Profitability Index, which is dividing the net present value by the cost of the project. An example, it's 1 million divided by 1 million. So the Profitability Index is 1. If we find that the $2 million project costs $5 million to run, then the Profitability Index is 2 divided by 5, or about 20%. And you just go for the highest Profitability Index. In the example I'm just mentioning to you, Profitability Index would be the comparison between 1.0 and 0.4. And so you would make the decision on that basis. So that's a way of dealing with those differences in life and differences in magnitude. Okay. This is a useful set of slides or group of slides to read through. When we're talking about harvesting an asset, it's really another way, it's a more polite way, more positive way of saying when to retire something, when to scrap it, when to throw it away. Okay. If you've got some, let's say a production machine situation, you're making widgets using a widget making machine, and you find that a brand new widget making machine is a very efficient thing. It doesn't cost you much in downtime or service costs and all the rest of it. But as the thing gets older, what you're finding is that the value of the widget making machine is getting lower. The amount of time you're losing because of repairs and so on is getting bigger. And also the cost of maintenance is getting bigger. And you'll get to a point where you think, oh my goodness, keeping this widget making machine is just not worth my while. I'm going to scrap it. I'm going to buy myself a new widget making machine or go into some other line of business. Okay, this is what's being dealt with here. Those of you who are interested in motor cars, you can probably see a certain similarity with motor cars. You might think about buying yourself a nice new whatever, four-wheel drive or something. That's fine. And you'll drive it out of the showroom and feel as happy as a pig in mud, and that's fantastic. And if it's a four-wheel drive, you'll probably go driving in mud all over the place. But after you've had it for maybe 5 years, beating it about in the scrub, maybe 10 years, you'll get to a point where you have driven around in so much mulga that the four-wheel drive is starting to fall apart every time that you hit the ignition on it. And you're saying, on one hand, the value is going down, my resale value is going down, My maintenance is going up. My enjoyment, therefore, is really falling through the floor. Time to get a new one. Okay? You can relate to that with a certain amount of passion when it comes to a motor car, but financial managers in companies use exactly the same thinking for projects, when to retire a machine, when to retire a factory, when to stop a particular line of business completely. Okay? And that's what we're covering with here. And you can just read through those. So on. Now we're going to move into chapter 10. About this stage, I think we can take a break. We're on 3:07, so we might take a 10-minute break. I'll ask you again to remind me to turn the recording back on, and I'll see you in 10 minutes. So we're in business once more. Okay, what we're going to be doing now is looking at more of the background issues, if you like, to working out this question of capital budgeting calculations. Now we're looking at some of the stuff that I introduced at the very beginning of our class. Remember I was talking about variable costs and fixed costs, and what we're going to be doing now is just looking a little bit of how they can affect you. You can make decisions that change between the balance of fixed cost and variable costs, and they have implications in terms of the profitability of the company and the way it responds to uncertainty of risk. And so it's worth being aware of those. And so let's just run through how that all works. If I consider some situation, for instance, I might have a situation where I'm working or running an excavation business. Just hang on for just a moment. What's going to happen when you're giving classes off-site? Okay, where are we? We're talking about variable costs and fixed costs. The example I'd like you to think about is a situation, say I'm running an excavation company and I need a bit more earth moving capacity. I'm thinking about buying another excavator. I need another excavator. The question I have is whether or not to hire one or buy it. Let me just go back to sharing the screen. Made a bit more interesting look at my face. And this is what we're looking at. Okay. If I go down to Kennard's Hire or something and bring home an excavator for the day, it's going to cost me a certain amount more for my excavator in terms of rent per hour, operating per hour. However, the fixed cost involved in paying for the excavator, like, if I actually bought it and had to, pay the bank back for the loan, is quite low. And so buying it means I've got a high fixed cost, but relatively low variable costs, cost of diesel and whatnot. If I hire it, then my fixed costs are low, but my variable costs are quite high, because every time I want to use the excavator, I've got to go down to Kennard's Hire and pay a fair bit just for, an occasional rent. Okay, that's the problem that we're looking at. Which is the answer? Now, in earlier and simpler times, you'd simply say, well, if your business is any good, you should be buying the thing. Well, it's not quite that easy. And that has to do with our uncertainty and our management of risk. Let's go through these slides. This goes through the theory of it. And again, I'd like you to just read through these. And what we're looking at is what's happening over time with uncertainty as we go from balancing our business using more fixed costs compared to more variable costs. Read through the examples. And I want to get down to this diagram. This diagram is very, very useful because it illustrates what's really going on. This example shows the way that if I put myself in a situation where I've got a fixed cost, while that will make it cheaper for me if I'm doing a lot of business, it's actually more expensive for me if I'm only doing a small amount of business. So when my excavating company, let's imagine all my machines are fully occupied. And my question is, how much extra business do I have? Do I have enough business to occupy the excavator full time? In which case, if I owned it, and let's use the ownership line here in red, I would say I'm going to have a high amount of EBIT, you know, that profit, that earnings after operations, before interest and taxes. Whereas if I was to rent it and I did a lot of work with it, I'd have a lot of rent charge. So even though I'm making a lot of revenue, my variable costs are quite high. And so my overall profit here is going to be relatively modest. However, at the other extreme, if in my excavating company, I really only have enough work for, you know, an excavator maybe, you know, 2 days a fortnight or something, or 3 days a month. So I really don't have a lot of marginal business available for it. Then the fixed cost involved in, you know, paying the bank back for buying the excavator actually means that my net earnings before interest and taxes is actually a lot lower, because I've got these fixed costs that are actually dragging me down. Whereas if I've only got use for the extra excavator, you know, 3 or 4 days a month or something, well, if I don't need it, I don't use it. And so I'm relatively insensitive to the fact that I don't have that much work. So the cost there isn't nearly as bad. Okay, read through this because that's basically what I've just been telling you about. Here's a worked example. I thought we had another, we don't have another diagram. There's another related diagram, it's very common. I think you'll find it in the textbook. Okay. There is a leverage quantity, which is fairly common in financial management. We don't have to go through it in great detail, but I'd like you to be aware of it. It's referred to as operating leverage. Normally when we use the expression leverage, we're thinking about debt leverage. In some cases, we're thinking about leverages that are other parts of your capital structure. And capital structure is always the balance between debt and ownership, debt and equity. But the operating leverage is a ratio that you work out that enables you to look at the multiplying factor, if you like, of every marginal dollar of revenue, depending on your balance of fixed costs versus your pre-tax, your EBITDA. That's the background to it. If you read through that, it's pretty much what we're explaining here. It actually gives you this multiplier amount, if you like, for every extra dollar of revenue. How does that actually translate into EBITDA? So read through that. The useful thing to know about, if I say it's not going to be on the exam, or it's not necessarily going to be in the exam, you guys are going to suddenly say, oh, in that case, I'm not interested. But, you know, there you go. Calculating operating leverage is worth knowing about to some extent. You can see the example here, worked example. Another practical tool in looking at how to manage your fixed costs versus variable costs is break-even analysis. Break-even analysis is working out the point where your scale of operations causes you to just cover your costs, and therefore you're at a sort of a zero spot. If you have high fixed costs, your break-even point is going to be high because you're going to have to be working harder in order to make that income. If you have low fixed costs, let's say I have my excavation company and I rent all of my machines. I rent them by the hour. What that means is that basically every job that I do only has variable costs, and so my break-even point is very, very low. It's not as though I've got, you know, $1 million worth of interest to, you know, repay every year, and so I've got to have them all working fairly hard. The break-even point when you've got high fixed costs, gets to be a lot higher. So read through that, and I find break-even point is a bit of fun because it's actually quite an easy calculation to do, and it's a very useful, practical tool. But with these things, and with all ratios in finance, don't take one ratio, because often what happens is you've got to consider other things. Like last week when we were talking about using NPV rather than IRR, fantastic. This week I'm saying, yeah, don't do that until you've worked out your profitability index and your annual equivalent NPV and so on. You know, you've got to actually look at the whole picture and make a decision on a number of factors. So break-even analysis is only one part of the whole puzzle, but it's a useful piece of information as you work through. An example of how to work out break-even analysis, basically just going through and giving you the numbers. Okay. Right, break-even analysis, risk analysis. Now, assuming you've done your net present value, or for that matter, your IRR, if you're fond of those creatures, you're still making estimates into the future, and estimates are only estimates, they're not certain. There is risk and uncertainty attached to them. When you're doing your modeling, therefore, you're working out your discounted cash flow model, you have to take account one way or another of the fact that even though you might be doing the best estimates you can for the various numbers that go into it, you know, in so far, let's just have a look at an example. Here you go. Very lovely, impressive looking model. And what we're saying is we're estimating what our profit and loss statement is going to look like for year 2 and year 3 and year 4. But realistically, I don't really know what those future numbers are going to be, right? They're only estimates. We might have a good year. We might have a government change, which might sort of throw everything crazy. We might have, you know, another coronavirus. We don't really know what's happening in the future. How do we evaluate the impact of those uncertainties on your net present value? Because after all, you're going to be using the net present value to make these decisions. And so you really want to find a way of working out how reliable those estimates are. There are a handful of tools that we use to evaluate the uncertainty in our models. And we'll just go through some of them, and they're listed down here. We'll go through them briefly. Sensitivity analysis is a tool where you take each element in your model and you see what impact it has on the net present value. If it has a big impact, we would say that the NPV is very sensitive to that particular value. For instance, if I own a investment property, investment bit of real estate, it'll probably be likely that the attractiveness, the NPV of that investment, will be very sensitive to the level of rent. Rent goes up, the attractiveness of the investment goes up. Rent goes down, the attractiveness of the investment goes down. So it's going to be very sensitive to that. Is it going to be very sensitive to changes in local government rates? Okay, local government rates might cost me $1,000 a year. Maybe if the council gets really aggressive, they might go up to $1,050. Or maybe they might only go down to $990, whatever. Is that going to make or break my investment? How much of an effect is it going to have on the net present value? Well, change in government, local government rates is probably not going to make a big difference, but a change in rent can make a huge difference, right? Sensitivity analysis is simply going through, looking at each one of the variables that make up your model, your discounted cash flow analysis, and seeing what happens as they change. Commonly, what will happen is that analysts doing this will look at the most likely values. So I'm talking about a property example. That might be, you're looking at the rent. So say the most likely, I'm expecting to get $500 a week for rent for this particular piece of property, whether it's a shop or a house or whatever it's going to be, $500 a week. I might look at what happens in sensitivity analysis, an optimistic situation where I think, oh, actually, maybe the rent might be $600 a week. Oh, wouldn't that be nice? That's optimistic. Or I might be pessimistic and say, well, maybe the rent's only going to be 450. That's pessimistic. And so commonly, certainly in the olden days when calculators or computers weren't so strong, sensitivity analysis was often done by taking the most likely value, the best guess, and then seeing how sensitive it is to a more optimistic view and also a pessimistic view. So you'd have these three choices that were investigated, and that would give you an idea, a feel for how sensitive the project is to a change in that particular variable. And you do sensitivity analysis for each one of the variables all the way through your model. And by looking at those, you get a bit of an idea of how the whole thing is going to wobble around in the vagaries of the future. The problem with sensitivity analysis is that because it only takes the variables and analyzes them one at a time, you never really get an idea of like compensating effects and reinforcing effects. You know, what happens if inflation goes really high and interest rates go really high, and I don't know, Australia's foreign exchange kind of moves the wrong way, or what have you. You know, if you had all those things moving at once, do they aggravate the situation? Do they compensate? Who knows, right? To analyze all of the sensitivity, like the variables at once, together is pretty important, because otherwise it's a bit unrealistic. It's unlikely to have interest rates go through the roof without having that rattle through and cause all sorts of other impacts in the economy. But sensitivity analysis itself isn't able to cope with the analysis of more than one variable. There are kind of tricky ways of getting around to doing two variables, but apart from that, it's pretty hard. But on the other hand, the real world moves from one situation to another situation to another one, right? Again, you know, look at what happened, say, last year in our economy. Any business really was sort of humming along and had one situation. This year, we're moving into a different situation, the coronavirus situation. Everything has changed, right? You've got different levels of revenue, you're going to have different levels of cost, you're going to have different levels of wages, all sorts of things are going to be changed. So it's a whole package. The analysis of uncertainty in the whole package of variables is what you get to by looking at scenario analysis. Scenario analysis basically says, I've got the most likely scenario, this is what I think is going to happen over the next 5 years or 10 years. But I'm going to say, well, maybe the world might turn out better than that, and a whole lot of good things might happen. And so I'll look at a realistic scenario, which is optimistic. I might look at another scenario, which is the wheels fall off, everyone's died of coronavirus, you know, what's going to happen? Okay, so a pessimistic one. And so I've got scenario, 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 optimistic, most likely, optimistic, pessimistic. My experience with building scenarios is actually kind of interesting, because one of the things I found when you do these things in real life, sometimes it's easy to dream up a scenario which is realistic. But just think, you know, when you're actually doing this, if you find yourself working in a business in a situation where you're actually doing this work, and this is real work, you've spent a lot of time working out your forecasts. You've gone to a whole lot of sources, maybe you've talked to people, read things, gone to the RBI website, look at commentators, done a whole right? And you've worked out as best as you can the likely pattern of where your cash flow is going to follow. So you put a lot of effort into that. So that's your most likely case. After you've done that, you've then got to work out what would happen if you were wrong, more or less on every variable, and say, oh, I was actually unnecessarily pessimistic. I'm going to look at a likely future, like say for Australia or Queensland or Victoria or something, which is a lot rosier than what I thought was the most likely thing to happen. Psychologically, from personal experience, I just find that a lot harder, because you've just invested all this, if you like, emotional energy or rational energy or whatever sort of energy it is into getting the most likely. And then you've got to say, yeah, okay, well, that's the most likely one, but I'm going to forget that for a moment, and I'm going to put on my Pollyanna hat and dream up another scenario, which I'm going to be able to argue with at least as much enthusiasm to say the world's going to be a better place than I really believe it is, right? And then likewise, you're going to have to do a pessimistic scenario. What was that donkey in Winnie the Pooh? Eeyore, right? Eeyore, the pessimist, right? And you got to put your Eeyore kind of ears up, and you got to say, oh, it's going to be really gloomy, the world's going to end, da, 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 da. You got to work out a scenario. But that's basically what you do with scenario analysis. Sometimes it's good when you're building scenarios to picture particular events. What would happen if, I don't know, some foreign power invaded Australia? What would happen if the government decided to stop public welfare? What would happen if the last of our manufacturing was sent overseas? What would happen if the Chinese did actually buy all of our mines and brought Chinese workers in? Right? And you can sort of imagine these possible, and all of those things are more or less possible. It's happening already as far as foreign companies bringing in their own workers using their own industrial relations arrangements and so on. That's starting in Australia, and it'll probably happen a lot more. So if you use those, you can sort of dream up very realistic alternate scenarios, and that's the sort of thing you're doing with scenario analysis. But by and large, dreaming up likely alternatives is a bit demanding, and it's also relatively limiting, but you end up with a discrete number of them. And we get to, as a result, it's kind of limited. Okay, we saw that sensitive analysis was the advantage. It's easy to calculate, but you're only doing the variables one at a time. Scenario analysis got the advantage that it looks at the variables as little packages, so it overcomes the unrealistic aspect of sensitive analysis by looking at packages of values, right? But dreaming up likely packages is a bit challenging. Okay, that's where you get to the third one, which is simulation analysis. Simulation analysis is where you get a computer to work out your scenarios. And computers being what they are, they're able to work out scenarios very quickly. And you get the computer to simply work out scenarios randomly. It just sort of takes random sets of variables within, tolerable limits. And it just works out the NPV for this one, that one, the other one, da, 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 da. And it might work out 1,000, 10,000 random sets of scenarios, commonly referred to as Monte Carlo analysis. And if you hear anyone talking about Monte Carlo analysis, that's what they're talking about, simulation analysis using a computer, where you're basically doing scenario analysis where you get this randomized set of scenarios being calculated very rapidly. These days, computers have got fast, but I don't know if they're fast enough to really do this quickly. In the days when I was first taking an interest in this, which is now, well, a while ago, probably about the same time that you guys were in nappies, computers are a bit slower. And to do a Monte Carlo analysis of a moderately complex project, you would basically set the thing up before you left to go home for the night, press the go button on your computer, leave it on overnight, hope the cleaner doesn't switch it off, come back in the morning and it may have finished, because it might have run something like 10,000 random scenarios. And in the end, the computer says, yep, after running 10,000 random scenarios, this appears to be the average result. This appears to be, the span of uncertainty. And a lot of people put a lot of faith in the outputs of this Monte Carlo simulation, the simulation analysis. While we're talking about the upsides and the downsides, one of the problems with Monte Carlo analysis is that because the computer is just taking all of your variables, and a real project, then let's say a simple property project, might have something like 15 to 20 variables, different things which affect how the cash flows work. And the Monte Carlo analysis is simply randomly putting in selections, random selections for each one of those, let's say 15 variables, and running the probabilities. The problem with that approach is that while it appears to basically, check every possibility, and it probably does, the practical reality is that most of those random combinations of values are extraordinarily unlikely. And the reason is that the values for the different parameters in these things tend to be interconnected. For instance, there's a kind of connection between inflation and interest rates. And inflation and interest rates are two very, very important variables in a lot of these models. Generally, if inflation gets too high, the Reserve Bank of Australia will make moves to raise interest rates. And by raising interest rates, it will actually slow down inflation. Conversely, if inflation is too low, then the Reserve Bank will put moves in to lower interest rates, and that will cause the inflation rates to rise. And so what you have is this dynamism between those two factors. One's going up, the other one's going down, and vice versa. Through time, there's sort of relations from one period to another and so on. So they're connected. Monte Carlo simulation generally doesn't take into account for those interconnections between the variables. It simply takes them as totally random. We could go through lots and lots of other examples with particular values, if you like. But just, I say, out of that 15 or 20, say for a property investment, probably 2/3 of them will have some kind of connection to at least one of the other variables. Very few of them just sit out in space totally unaffected by the other values. So the poor old Monte Carlo simulation, it has the disadvantage that because it takes random scenarios, these scenarios are very likely to be unrealistic. And if they're unrealistic kind of scenarios you're taking account of, then there's hardly any point in the output of the analysis, because the analysis is giving the analysis of fairyland, basically. And so Monte Carlo looks very impressive, and your computer might have spent, you know, the 14 hours between knocking off and coming back to go and work it out, but it's not telling you nearly as much as it appears to be. The fourth form of risk analysis is the decision tree analysis. I'll recommend that you read through the slides on this one. It's a relatively simple, common sense kind of approach, and it works on probabilities. Actually, we'll duck down to the slide and I'll show you what I mean. First of all, you can read through these. Sensitivity analysis, here's a bit of a worked example. Working through. Sensitivity analysis, read through. Scenario analysis, I've talked through all of that so you know what's going on there. We get down to simulation, talk through all of that. Now we get to the decision tree. Decision tree analysis basically looks through each of the possible outcomes by breaking it up into a set of decision points. Let's look at that. Actually set out an example. Okay. What we might have is an example here. The example is a bit of new software being developed, not software, hardware. That we know that the cost of actually doing this development, in this case, just as a worked example, is about $250,000. That's fine. But then we say we've worked out that we reckon we've got about a 30% chance of success and a 70% chance of failure. Failure doesn't mean that you know, thing blows up and you make nothing at all. It simply means that you're not making enough to really be pleasing. In this case, you've worked out that if the project fails, you're likely to end up with a cash flow of about $50,000. However, if it's successful, you think, well, how successful? Successful to the point where I want to actually run with this thing, or really gangbusters, super duper successful, like high success, where it's just over the top fabulous and Microsoft is probably going to come out and buy you out sort of as soon as they can. What we have here is a number of decision points, and at each decision point we've got a set of probabilities, and by going through and working out the expected value, which is what you do by multiplying the probability, getting to the end there, by the expected cash flow, what you're able to do is work out basically a weighted mean. And the weighted mean is worked out a little bit more complicated way to the weighted means we've been doing so far. For instance, here we've got, to get the 200,000, what have we got? We've got a 30% chance, no, we've got a 60% chance of a 30% chance of 200,000. So we'd multiply 0.6 by 0.3 by 200, and that would give you the contribution to the weighted mean for that amount. Here, you've got 50,000 times 0.7, and then 1, so it's just 50,000 by 0.7. So that gives you the contribution to your weighted mean there. And this fellow, weighted mean, 0.4 of 0.3, so multiply those together, 0.12 times 600,000, and basically do the weighted mean by adding those together, and that will give you the probable, supposedly, the expected value of the NPV for that project. Okay, read through the example and read through the maths and just work it out with a piece of paper yourselves. It's very simple mathematics, this one. Okay, we'll go through. Okay, we actually talked about profitability index, so I've already done that. The last one we'll deal with is the modified internal rate of return. We haven't said very much about internal rate of return today, largely because, you know, I'm a bit of a fan of net present value. But there are some and this week we gave net present value a bit of a hiding, so we're going to also look at the downsides of internal rate of return. Last week talked about a couple of the problems with internal rate of return. Just remember which ones I covered. Oh, that's right, the multiple root problem with internal rate of return, and also the inversion effect. So there are some pretty major problems with internal rate of return. But there's a third one which I didn't mention last week. We'll just go through now, at least mention, and that is the fact that built into the mathematics, and this is a little bit hard to describe, but I'll just do it qualitatively. Built into the mathematics of internal rate of return is the assumption that the intermediate cash flows are able to be invested at the IRR rate. Okay, that probably sounds pretty obscure and arcane. But what I mean by that is that if I'm working out the IRRs and my goal is to accept the project which has the highest IRR, then the mathematics is actually does discounting using that IRR rate to end up with the rate which gives you a 0 NPV. But in doing that, it assumes that the discount factors are happening because the intermediate cash flows are able to be reinvested at the IRR rate. Now, there's a bit of a logical problem with that. Because the IRR of its nature, certainly the one that I'm going to choose, is the best rate of return available, it necessarily means that the reinvestment opportunities are going to be at lower rates than the IRR rate. Now, that is a tricky thing to get your head around, and I do really recommend that you read the textbook for it, because we could probably spend a lot of time just going through that one point, modified IRR. The way around this reinvestment problem, as it's called, and I'd like you to read up on this in your own time, is to so configure your model so that while it's working out the internal rate of return, one of your inputs in your mathematics is the likely opportunities for reinvestment. So you basically put in an extra interest rate of return, which is the likely alternative rate of return. If that sounds like gobbledygook to you, then I recommend that you go and read the textbook. If we had more time, we could go through an example. You probably only need to have a bit of a concept of what the MIRR is and how it works. You don't have to evaluate it. And in fact, oddly enough, while IRR zealots, people who like IRR, will stand behind the MIRR and say, well, that solves all the problems of internal rate of return, let's use it all the time. Even they debate whether the modified internal rate of return actually works or how exactly to calculate it. So it's a bit of a contentious area. We mention it because it does appear to solve the problem of IRR, or one of the problems of IRR. But I don't want to go into the maths of it because it gets very, very complicated, and even the best answer is actually quite controversial. Talk about profitability index. It's good. Yeah, look at that stuff. It's basically what I talked you through in words before the break. Value, before we move on. Okay, yep, read through that on MIRR. And so from a practical point of view, these last few slides are just taking you through the practical decision making. Largely, it is recommending that you use more than one unit or more than one measure to make your decision, which is probably the most important thing, and just sort of to be aware of the various traps and so on. Okay, that will take us to the end of the slides. Now, in the last 5 minutes, especially those guys who are still here and keen, I want to talk a little bit about the exam. Currently, I have written the exam questions, and there are 11 of them. And for those of you who look very closely at the unit profile, you'll know that there's also effectively 11 teaching weeks plus a week for revision. And so you can work out why there are 11 questions written. One of the things I wanted to get people to think about, or actually invite your feedback on, is how you would like to learn about what those questions entail. There are two strategies, if you like, for running the exam. And I want to run past what they are. And for some of you, you'll say, oh, hang on, I got a notification last night. Sort of Small's on the forum again, and he's inviting me to fill out another questionnaire. And I want to tell you what all that's about. I've had, the normal way to run an exam is to write out some questions and you don't know what they are, and you get into a lot of sweat and bother, sort of anxiety before the exam because you don't really know what the exam questions are. You get into the exam and you open the paper and you find either questions that you like or ones that you don't, and away you go, and then spend the next 2 or 3 hours working like crazy to answer them. Okay. I have been using a different strategy for my exams at different times. And I want to tell you about an alternative. The current exam, if we don't do anything, will work like this. It'll be a take-home exam, and when the exam becomes available, which will be at a particular time during exam week, the exam scheduling people haven't told me what the date is yet, so don't send me an email saying, hey, you know, when's the exam going to be on? I don't know. But everyone will find out once exams branch kind of work out that timetable. Take-home exam. The way it's running by default is that you'll open up a question paper and there'll be 11 questions on it. And on those questions, I will select 4 of those questions that you will answer as compulsory questions. And then there will be another 2 questions that you're able to choose from the remaining questions out of the 11. So 4 are set, leave 7, and so you take any 2 that you like out of the remaining 7. That's the normal way it works. And we can do that. And that's the way that originally I was intending to kind of release the exam to you. However, as I say, in older and simpler times, I have tried an exam strategy that involves giving my classes the exam questions early. And early for this class is next week. So if you like, I'm quite happy to circulate around during next week the list of 11 questions. Okay. And the deal will be, that way it gives you a bit more of a chance to focus your study. You know what the words in the questions are going to be, so that you can even prepare the kind of answers that you might think might be appropriate. I don't want everyone to do them all together. In fact, I'll get a little bit cross and crabby if I find that people that answer, I don't know, question 7 or something, you know, half a dozen students are all sort of basically just submitting the same file. That will not go down very well at all. But assuming you actually write out your answers individually, you're most welcome to study together if that's helpful for you, to just like talk out the issues and develop a really nice comprehensive answer to you. So what I'm saying is that if I give you the questions, by all means work together to refine your understanding, discuss amongst yourselves, you know, the best way of solving it or whatever, but don't say, okay, then I'm here with 10 of my mates, I'm going to do question 5, one of my mates is going to do question 4, somebody else is going to do question 10, and around you go, and you just kind of swap them all around so that each one of you knows an awful lot about one of the topics, but nothing about the rest of them, and you hand those in. So that would be considered as plagiarism. Okay, so just be wary of that. However, you can certainly work together to get your concepts working, and I really do recommend, even if you're out the back of Broken Hill somewhere, still be in contact with other people in the class. Work out ways of exchanging, getting some sort of a conversation, a discussion going, because it's very, very helpful for your own learning. Okay. Okay. By all means, if we do that, I can give you the exam questions. Because there's going to be a lot more opportunity for you guys to prepare good quality answers before the exam, what I propose is that we'll set the questions as 20 marks each, so you'll only have to do 3 of them. And the way it'll work is that I'll set, my goodness, what's happening there? I'll set 2 of the, someone's having fun. Let me get back to the point. Okay, there'll be 3 questions in the exam if we do the release of questions next week, and I'll set 2 of them. So I'll be choosing 2 questions randomly out of the 11. You'll be able to choose anyone you like out of the remaining 9, and you only have to do 3 answers, right? Right, so that's the possibility. I don't want to impose this alternate on you, but I am inviting people to consider which approach they would like. Sight unseen, 11 questions on the day of the exam where you have to answer 6 of them at 10 marks each, or have the exam questions released next week where you only have to answer 3 of them at 20 marks each. Okay, that's the option. In the past, when I've run these, I've found that they've been very successful with the results have always come in very nicely. I think they're very effective at getting people to learn stuff, and the feedback I've had for students when I've run them, and I was running them all the time for a long time, was that it's a far happier way to do it. You end up with less stress and so on. The only disadvantage from a student's point of view, I'm told, is that it makes you learn more. On the other hand, you can go in, no anxiety, well prepared for the exam, and I think for a take-home exam, it would be a bit of a delight because it'll just be a matter of basically loading up the questions that you may have written out beforehand. Okay, they're the possibilities. There's a SurveyMonkey survey that was released last night. I would like people to vote on which approach you would like for the exam. And if I get a substantial a substantial majority choosing to go with the alternate approach, which is release the questions next week, then that's the way we'll go. If I don't get a substantial majority wanting the alternative, then we'll just go with the regular exam, the way that it always runs, okay? So give it some thought. If you decide on a view, please do the SurveyMonkey survey, and I'll be looking at it probably Friday evening or what have you, or whatever, and making a decision there. And certainly by the time we get to next Tuesday, I'll be looking at the results from the survey and making a decision accordingly. Right, so that's the plug. I think we've just about run out of time. Do we have got a chat? Where can I find the survey, Natasha? If you go into, let me find it myself and show you. Oh, hang on, what have I got here? Whoa, I better make sure that I don't show something unexpected, like the answers to the exam or something. Here we go. If we go into information, this is the middle site for what we're doing. Go into information, news forum. Come down here. That was the post from last night. Open up that post and you'll see the link there. Okay, that's the link there. Just open up that link and that will take you to the SurveyMonkey survey, and away you go. It's also let me do this a bit slowly. You know, the welcome and Zoom site, the section in Moodle, which is where we put the recordings for each of our workshops. We get down to number 7. Okay, that's yesterday's workshop class. I might put today's up there next to it. Profit and loss statement summary, that JPEG that I showed you, the Excel spreadsheet with the up and down arrows, and there it is again, the exam format survey. So 2 places where you can find it, either through the news forum or on the page there in the same area where I've got the recordings of the workshops for this week posted. Okay, thanks for that question. Good question. Any other questions before we finish, or we'll just pack up? Looks like everyone's happy.
Sir, I have a question for the assignment 1.
Good, yes.
It's for the 2.1, the question 2.1 of the assignment.
Okay.
Yeah,
Yep.
I'm not sure what we have to do.
Let me just find that. Okay, question, I'll just put a student number in here. So I've got a bit of data. Question 2.1, you're looking at this, a question in there. Mary has just inherited a parcel of shares, that question? Oh, sorry.
Yes, that one.
1.2. 2.1. Mary has just inherited a parcel of shares. Let's make it a bit bigger so that we can see it through all of the vagaries of the camera resolution and stuff.
I'm sure if you're wanting to share screen or not, but we are unable to see the screen.
Oh, sharing screen, thank you very much. Share again. Okay, now you should be able to see it. Mary has just inherited a parcel of shares. She anticipates an annual dividend of so many dollars. She is thinking of selling the shares in 10 years' time and estimates that they will be worth F dollars by then. Okay. Question? You want to work out, the question is what's involved in the question. Would somebody like to just give their idea of what the answer to that question is? Young fellas.
read the very last line in the question. That's how I figured out the formula.
Say again, Tasha?
Read the very last line in the question.
What
That's how
is
I
the
determined.
value of her inheritance in today's dollars?
Yes.
Okay, that means we're really asking a present value question. If I can just get that diagram back up again. Oh, where's it gone? Cash flow diagram. Just going to get this fella up. This diagram is probably a handy thing to be looking at for this particular question. Let me see if I can just get them so we can see them both at the same time. Okay, there's the question. It's telling me that I've got an annual dividend of G. So in this diagram, the annual dividend could be the $100. So I've got 10 years. So it's just like this diagram. I've got G dollars, G dollars, G dollars, G dollars, G dollars right up to there. And in addition, they're going to be worth F dollars by then, which looks like this future value amount here, like the second up arrow. So I'm going to get 10 dividends of G dollars. And in addition, at the end of the 10th year, I'm also going to sell the shares. I'm going to sell them for whatever their sale price is. It's called the FV, future value. And what you have to do is bring all of those back down to the present value and put all of those together and sum them, like present value them, then sum them. For instance, in this case, the other bit of data which is really important is the E%. And so that's the discount rate. Okay, if E in your example happened to be, let's say, 10%, and G was 100, and F was 1,000, I don't know what they are in our examples here, then what this diagram is showing you is actually the solution for that puzzle. Now, that's not the values you're going to have, but it's just an example of how it works out. Okay, in this case, by happy coincidence, this particular pattern of cash flows and discount rate does give you the PV equaling the FV. Those of you really mathematically shrewd will know that has to be the case because the relationship between the dividend and the future value, but I'll put in a different number just to make it a bit more interesting. Okay, and that's more typical, but that's the kind of problem you've got. Okay. So I hope that makes sense to people.
So it's like the sum of the 40 years dividend?
Yeah. Yeah, what's happening is, you see, you've got G dollars. Well, I'm going to have to leave. Just hang on for a moment. Sorry about that. Where was I? What was the question?
I mean, there's the result of that question is the sum of the 40 years dividend.
That's right. That's right. You see here what's happening in this particular set of data, the $100 in 1 year's time is really only worth $95 today. The $100 in 2 years' time is only worth $90. $100 in 9 years' time is worth $64, and on it goes, right? So I've got all these little checks coming to me in the mail. And in addition, I sell it in 10 years' time, so I get my $100 and I get the 1,000. But by the time I get the total of 1,100, which is the sale price plus the dividend, 1,010 in this example, By the time I take the present value of that, it comes down to $61.39. But then I add each one of these 11 numbers together. And, oh, you guys can actually do this yourselves, but you'll find that it adds up to the 1386. What that is telling us is that if the prevailing rate of return is 5%, and someone offers me this set of cash flows, right, I should be prepared to pay $1,386.09 in order to buy it. If I can buy it for $1,000, I'm happy because I'm in front by $386. If the vendor, the seller, is greedy and they say, I'd like $1,500 for this, I'd say, I've done my sums, not worth $1,500 to me. In fact, I can do other things with my money that will end up causing me to be about $114 better off. All right? So the whole thing about net present value and so on is that it gives me a decision rule, if you like. Okay, but from your point of view, this is the rational, this is the financial value of that assessment. It doesn't tell you what it's actually going to trade for in the market. The market might be crazy. The market might be really pessimistic or optimistic. People might be buying these things at 1,100, or they might be buying it at 1,500. You don't know. All you know is that this is what a sensible person should pay for it, because this is really what its financial value is. Okay, and the maths is what I've described here. You may find it useful opening up this spreadsheet and playing with it. This actually comes from a different class, and some of you people, especially the people doing property economics, will discover this thing in about 2 years' time, or when you do advanced valuation is where this model we deal with. But I thought I'd give it to you in this class because it does really help your conceptualization. And so for you property students, you know, next year or the year after, I might be seeing you, and this will be really familiar, but very, very handy tool. Let's go back to here. If you, let me get this bigger, come on, big. Now I've ruined it. What am I trying to do? Trying to get you to be able to see that when we get to the week 7 stuff, there's yesterday's class up. But this cash flow diagram example, I do recommend to you to download that and play with it. Okay? It's, as I say, it's not really for this class, but you'll get a lot of benefit from it, right? And it'll help you with that 2.1 question. Okay, we better go because, as I say, we're running a bit long on time now. I do appreciate your interest and your questions.
Thank you.
Most welcome. I hope that helps you with that question. Okay, we'll finish the recording.